Okay, let's do this. Hi, everyone. Thank you for pressing play. We have a really fun episode today. It's not just the three co-hosts, Sam, AJ, and myself. We have a guest. Tomasz Tunguz is here to join us. Thank you for joining us.
Oh, pleasure to be here. Thanks for inviting me to join.
We're excited to have you.
Yeah, super excited.
This is Top Line.
This episode of Top Line is brought to you by Affinity for Salesforce. Affinity for Salesforce brings powerful automations and deal-driving relationship intelligence to the Salesforce CRM and extends these insights into your email and browser. Automate the creation, update, and enrichment of Salesforce records and use your network and relationship insights to find, manage, and close more deals. To learn more, visit us at go.affinity.co/pavilion. That's go.affinity.co/pavilion.
I'll talk a little bit about your bio and then we'll jump into it just for the 2 or 3 listeners that might not already know who you are. And then we can freestyle from there. So you are the founder and general partner of Theory Ventures, which is a $230 million fund, which you started in September 2022. You've spent your career in the tech space, early employee at Google, 15 years at Redpoint. You invested in 7 unicorns in addition to a bunch of other companies like Looker, Chorus, Monte Carlo.
One more company.
And the companies you've invested in always have great names. One is called Mother Duck. The other is Monte Carlo. Yeah. That's amazing.
That's a great name.
All right. Anything to add to that?
No, I think it's phenomenal. Thank you, guys.
I have one thing. Tomasz was the first. Were we the first check that you wrote at Axial in like 2011, 12?
We were the second check into the company. It was my third investment in venture.
And he was the first big time VC that I ever met. Was probably 15 years ago at this point. So pretty incredible.
Anyway. Tomasz never invested in any of my companies, but
well,
I do have.
You had an exit.
What the hell, Tomasz?
I do have a great story, and Tomasz, you might remember this. It's my most vivid COVID story that I have. Is we were about to raise our Series A. And I got introduced to Tomasz, and it was Friday, like March 12th or March 13th. I had this meeting scheduled, and I an hour before the meeting, I was at my wife's childcare center, and like the Trump had just come on saying like everything's going into shutdown, and Pennsylvania was like really close to the epicenter of New York, so everything shut down, and like we didn't know what that meant for. My wife had 12 people on the payroll, and so we just shut down the center. We're like, I guess we're just paying for the next however many months until this lasts. So I had canceled all of my meetings except my meeting with Redpoint. And I get on the call and I'm like, and you guys were so gracious. You're like, do you still want to have this call? Like, I don't know. This is such a weird situation. Yeah. But right before it, you were really, really showed a lot of humility with it. So I really appreciated. I went in the bathroom and threw up because my wife's center was shut down. And I remember getting on this call and having such a great conversation with you guys. So thank you for that. I don't know.
No. Gosh, what a stressful moment. I remember you telling me this story. On a little bit more positive note, I wish there's a small part of me that wishes we could all do COVID again because I think we'd all do it so much better.
Well, if you're talking about 0% interest rates and all that secondary, absolutely.
I actually had no idea all of you knew each other. This is so cool.
Well, that one story. I'm not. Yeah, that's the one story that I remember very, very vividly. So.
Yeah.
Well, we're really happy to have you. In terms of how we do this is the Wild West. No, it's more like jazz music. There's a structure and a lot of improvisation. So we have a couple of questions that are jumping off points and we freestyle from there. So I'll throw the first one out and then we'll go from there. So today we want to talk a bit about Theory Ventures, the founding of it, your thought process there. We want to talk a little bit about your 2024 predictions, and then we want to talk about AI. And so let's start with Theory Ventures. You launched the firm in September 2022. This was after 15 years at Redpoint, and you've mentioned in the past that you always wanted to start your own business and wanted to experiment a bit in venture. And the experiment that you wanted to run is that you wanted to deploy a thesis-driven, concentration-based strategy to venture, which would mean that this $230 million fund that you've raised would be deployed somewhere between 12 to 15 companies. And what allows for that is that thesis-driven approach. The question is, that how did your experience starting, in your words, a little company when you were 17 years old play into your desire to eventually start your own business? And also, what was that inflection point in your venture career where you developed a lot of conviction around this thesis-driven, concentration-based approach to venture?
Yeah, so when I was 17, I started a little legal software company with my dad in South America. And so I went to visit a friend, and he was a lawyer, and he started his own firm. And he looked at me and he said, "You look like a smart kid. You're from the US. We're 4 months behind in our bills. Can you build us an Excel macro?" And this was like an international law firm that was like billing with multiple currencies and multiple languages. And so that kicked off this little business. So he paid us a consulting fee to start this business. And then we ended up selling it to two other law firms, and 75K ARR business, paid for college and grad school. And that's how, and so I was taking customer support calls in my dorm, and understood what it's like to do mid-market sales at very, very small scale. And then after that, I realized we didn't know what we were doing. I didn't know what I was doing. And so I went to work at a startup I was managed by professionals who were like 27 years old. Well, more than I did. And I fell in love with this idea of starting companies. It's just so addictive because there's this like direness. There's this need for survival. It's so raw. It's so pointed. It's addictive. It's like, living on that edge a little bit. And so after 15 years at Redpoint, I do a lot of quantitative analysis, and the venture capital asset class, 8 to 300 billion in about 12 years. So really matured quite a lot, and just started doing math on venture capital returns and running Monte Carlo simulations, which was some of my graduate coursework on outcomes. So came up with this portfolio strategy, and now we're 6 people and just about to close on investments 5 and 6, and in 10 years we'll know if the strategy works.
When you started doing that, Tomasz, when you started doing that strategy, and you hit like more of a public influence pretty quickly, it seemed like, but maybe like all these stories are, you had been doing it forever, and then eventually like that you get like a little bit of an exponential following. Were there others that you like followed, that trailblazed, that you were like watching, or did you just do this on your own? You're like, I just should make this like public for people to consume.
The blog, you mean?
Yeah.
So when I started writing the blog, there was Fred Wilson's blog that was really broadly read. There was David Hornick at August, who had a blog, and then
David Scott was probably there.
Those were the 3, and so I just started writing it. And I remember being in a board meeting where a founder asked, like, "What are the benchmarks for ARR per employee?" And I come from Google, and I was like stunned that a lot of this information just didn't exist. And so I just started writing. And then as an associate at Redpoint, when I started, one of my jobs was to gather the news every week. And so I would present on Monday partner meetings, like, here are the 30 news stories that matter for us. And then I just took it, and this is not proprietary. So I started publishing it every Monday, and that created a cadence.
Yeah. That's awesome.
That's really cool. Part of your approach has been having this point of view on where things might be going and then adjusting to that. So when it came to raising your fund, you were doing it at this really interesting time. I don't know the exact timelines, but it seems like when you were raising the fund, it must have been around when inflation was a known issue, interest rates were coming up, public markets had corrected, but private markets lagged public markets. And so there must have been this like disconnect there, and that must have made for some really interesting LP conversations. But the thing I'm curious about is, since you do this thesis-driven approach to investing, and the biggest investment you can make is the investment of your time, you must have had this point of view on the market and the timing to create theory. What did you, and if so, how is that thesis played out? What did you get right? What did you get wrong?
Yeah, a big part of it was just chance. A big part of it was chance. But I think what I'd seen in 2008, like everybody was leaving Google to start companies, and my smartest colleagues were leaving to start companies in that downturn. And their rationale was, in downturns, It's the people who have like a lot of conviction or who are really, really like gritted out, because it's not easy. And if you can survive and thrive in that kind of environment, then when the market comes back around, you should be in a really good position because you've learned a certain set of disciplines. And so, like I said, a lot of it was due to chance, but I'm grateful that we started during a really difficult time, because I'm hopeful that the discipline of that time permeates culture.
Oh, that's so
but it was really tough. I mean, I remember like I was talking to a couple of different LPs, and they have, let's say you have an investment book, right? Your entire portfolio, and half of it is in publics, and the publics are marked down, and so now all of a sudden your privates are here. But I was talking to a lot of LPs where they didn't really understand. They didn't know, how much do I have in real estate? How much do I have in venture capital on a relative basis? And so they couldn't invest, because all of a sudden if the publics halved, then the privates were worth a third more. And so they thought, well, we're massively overweight privates where we're supposed to be, and we have to wait for the managers, the venture capital managers, private equity managers to mark down. Well, it's probably like 6, 9, 12 months before they marked down. So so it was a tough time.
Very interesting.
Do you feel like there's a lot of parallels to the 2008 and what entrepreneurs and founders are going through today? Or do you think this is just a totally different environment and ball game?
I think 2008. So I started 3 months before Lehman fell. And 2008 was different in that they were still a hangover from the 2001 crash. If you look at venture capital investing during the aughts, during those 2000s year, it was flat. And I remember very distinctly, there was one year where Lightspeed had backed 4 companies that went public but were sold for multi-billion-dollar valuations, like the AppD acquisition and 3 others. And that sort of opened the market again. And everybody started investing, and, the Fed was printing money. I don't think we've had that. It's different. We've had this huge run up, and now we have a little bit of a hangover from it. So I think it's different in that sense. But in terms of down rounds, recaps, hard times, lots of layoffs, that there's a parallel, and also a drive to profitability. I remember one of the first companies I've invested in, their monthly burn was like $100K. And seeing a company burn $200 to $250K was a lot of money to burn in a particular month. And you think about like 2021, I was looking at companies, and companies were raising capital burning 2.5 months, 10x. So I think it's a little bit a different time. Now the big question is like, what does the next 10 years look like? Is it the 1950s equivalent? Is the 1970s equivalent? Diamond said this morning that looks like the 1970s for him. And so reward notes.
What are the theses behind Theory Ventures? And I guess I'm curious on what I remember from the last year of reading your content and blogging, et cetera, is a deep interest in, you can call it Web3 or blockchain. And I'm curious if that's part of the thesis behind Theory Ventures and how that's evolved, because obviously there's been a little bit of a crypto run up in the last 2 or 3 months. It's like tempered a little bit in the beginning of the year. I think based on like a Bitcoin ETF possibly, and maybe some like new NFTs that are being minted on Solana. But generally speaking, there's still a lot of skepticism and doubt about the practical use cases behind Web3 and blockchain. So curious, this is sort of 2 questions. What are the theses behind Theory? And then what's your current perspective on Web3 and crypto?
Yeah, great question. I think the BTC ETF was just approved
today.
Yeah, today, like anyway,
look at Sam smiling. The man is making some money.
You can just hear all those dollars going through.
Exactly. I never sold.
So we believe data is basically the most valuable asset there is, and that software uses data in order to extract value. And so there's 3 parts where we invest. The first is the modern data stack, the BI systems database. The second are applications infrastructure for machine learning. And then the last is blockchains as database. So we look at Ethereum, and it's worth 5 snowflakes put together. It's the fastest growing database, most valuable database of all time. Most people don't look at it like a database company, but that's the way we see it. And to kind of give you a sense, as a business, Ethereum was burning, talking about cash burn, they were burning 1.7 billion a quarter. And 2 quarters later, they were producing 200 million in free cash flow. Greatest turnaround ever.
Wow.
Is there a they to Ethereum? There's like a company that is Ethereum?
There's a foundation. Yeah, that's right. So it's a little bit of a different construct, close to like a university. It's it, but the P&L of that foundation is remarkable. Anyway, so we look at them as databases, and a lot of people in Web3 don't like to think about them as databases, but we look at them as databases. And what we think is, okay, you guys remember when AWS launched in like 2008, 2009? So AWS had about 120 price reductions of EC2 and S3 within the first 3 years. And so every time there was a price reduction, we would announce that would bring more people. And so we analyzed, okay, like 2 years ago, for me to send Sam an NFT on Solana, CryptoKitty, would have cost me $50 to $75. Today, if I want to do that on a modern chain or a next generation Ethereum L2, which is a modern database on top of ETH, that might cost like 2/1000ths of a cent. So you've had 1,000x reduction in cost. Okay, so the question then is like, okay, how does that compare to AWS? Well, it's still like 100 to 1,000 times more expensive than AWS. But if you've had a 1,000x reduction in cost in the last 2 years, at some point you have to believe that the cost of writing to a blockchain database become very close, maybe not identical, but very close to a regular AWS database. But the data is much more secure. And the data is now, the user custodies the data as opposed to the software company. And so our view is in the intermediate to the long term, next generation software companies will take the most sensitive information and very likely store them on a blockchain. Because you don't have to deal with GDPR regulations or data locality rules in Germany or the different laws between California and New York. Users custody their own data, you access it when you need to. And it's more secure.
So is the thesis that the cost is the only barrier to entry for like why any of our companies wouldn't write to this database?
Yeah, I think it's cost. I mean, the latency is coming way down. I mean, so the database market, $100 billion market roughly, you have lots of segments now that 10 years ago were too small to produce a publicly traded company. Streaming data, you have Confluence worth 10 billion, right? So 1% of the database market, billion in revenue, $10 billion company. So if you want to take like a very narrow view, you could say, well, Web3 databases should be a specialty database for a particular kind of extremely sensitive payment information, the data, whatever it is. If they can capture 1% of the database market, you have a publicly traded business on Web2 multiples. You know, Web3 multiples multiplied by 1,000x. At some point they'll rationalize, but not for now. And so that's the idea. That's what we believe.
That's interesting. Sam, what was your thought process around, like, I think between Sam, AJ, and myself, Sam, you're the only one that has crypto right now. You held on to it while things were going down. Obviously, that's why you're smiling so much these days. So what was the thesis around holding on to it? Like you had conviction this comes back? Why?
Listen, after Tomasz articulates his position on Web3,
like,
asking me to say anything is really deeply unfair.
I thought what goes down comes back up. It will be fine.
my big thing is just that innovation curve, you know, and the trough of disillusionment. I've been burned a bunch of times in my life selling at the bottom, and my experience is that when something's deeply out of favor, that's probably a good time to hold on to it. And you know, and fundamentally, the arguments for blockchain specifically, you know, I still don't know, like I'm still not well versed enough on the technical details of how all of these companies actually generate value for shareholders or for token holders. But the fundamental point, I think, has some bearing, which is that to Tomas's point, it's a safe data. It seems to be the future, and all of the systems that we currently have in place have a bunch of security flaws and ownership flaws that I think Web3 and blockchain solve. I have no idea how it was going to play out. I didn't know when it was going to come back. Fundamentally, it's just I've sold stock at the bottom, and it was always a huge mistake. And my experience is Warren Buffett tells me to buy and hold, so that's what I do.
Well, I also appreciate that Asad just assumed that I'm not smart enough to own.
I thought you and I
he was like, between the three of us, Sam, you're the only one that
never said you owned any, so I thought you did.
I own 4 Bitcoin.
Oh my God, AJ, really?
Wow.
Yeah.
Right. You own 4 Bitcoin. That's not nothing.
I bought it in 2020 when everything also similarly when everything.
I'll tell you one thing. I don't know if we talked about this, but maybe I was talking about it with Asad, and this is a super contrarian take, but I was listening to Patrick Collison debate Bitcoin with Charlie Munger. And I found another reason to buy Bitcoin is that I found Charlie Munger's arguments totally incomprehensible as to why gold has value, but Bitcoin doesn't, when they're both completely arbitrary. May he rest in peace. He's a genius in most respects. But anyway, that's neither here nor
Charlie Munger.
We're not going to pile on to Charlie Munger now.
Yeah, exactly. Nobody else has anything to say. I'm just making enemies. All right, let's keep it moving, Austin.
Okay, let's keep it moving. Okay, so let's get into the predictions. You released your review on Jan 2nd. You released the review of 2023. Or your predictions from 2023, which you essentially nailed. That was really impressive. And then you laid out your 2024 predictions, which were super fascinating. We're currently at this really interesting point in the market where we've been in this downturn because of inflation and interest rates. And while the economy didn't go into a recession, it's fair to say that tech, or it's arguable that tech did go through a recession. We ended the year knowing that inflation's in a good spot in North America. Interest rates are going to be coming down in 2024. And then there are some downstream effects of that. And those downstream effects are not equal across public and private companies. And a lot of your predictions were around the state of the market from early stage to growth stage to the exit market as well. So we know that the private markets lag public markets. We've seen that the public markets have already reacted to the good news. What are your thoughts in terms of how the first half and second half of this year play out for early and growth stage tech companies?
So early stage has been unimpacted. If you look at the 75th percentile seed round, it's gone up every year, every quarter since 2008. And it was only in Q3 of 2023 that the Series A broke that, and it fell by 5%. So seed and Series A valuations for the top quartile companies, completely unimpacted. The B, C, D, they're more sensitive, and it kind of makes sense. They're closer to those multiples. So the volumes are down, right? The volumes are down significantly. We went from about like 300 billion, call it, to about 200 billion. So pretty significant reduction, almost 80% reduction in Web3 investing. But I think by and large, valuations kind of remain where they are. We've seen multiple expansion in the public markets. I just read the numbers were like 7.7 times forward. Historical median is about 5. Yeah. So we're still like a relatively nice place to be. And I think, okay, so why was 2023 down compared to 2022? Well, we all lived through it. Like, as you said, there's software recession. Nobody was buying software in Q1 of Q2 of 22. Nope. First mandate was let's just cut, let's consolidate on a bunch of vendors. And then what we started to see in the portfolio was Q3, Q4, companies had reduced plan. They started to hit their plan. Sales cycles shortened a little bit. You have people starting to expand. Net dollar retention came back. And so I think in 2024, we should see a better year. One, because you just remove those 2 terrible quarters in the first half of the year. And even if they're just 4 mediocre quarters, it's better than last year. So people should grow. But I think, like AI, we talked about this, right? You have 3 to 4 billion in ARR already across all of these different AI companies and growing super fast. That's a big driver. Everybody wants to spend there. And then data volumes increase. So like your database data volumes increase 20 and 30% per year. Observability, like Datadog and Splunk and all those guys, they grow 20 to 30% per year. And that's why Gartner is predicting this is the highest growth software market in 4 years. They expect global software spend to grow 14%, up from 12, up from 9. And even if they're like directionally right, I think it tells you that like that's a lot of money, right? On $600 or $700 billion worth of spend, you're talking about like marginal $100 billion of software spend in 2014.
Tomas,
Go ahead, Sam.
When you think about the capital requirements to start a company these days, one of the things that's on my mind is just growth stage B2B SaaS businesses that are sitting under difficult valuations. And even if they're growing 20, 30% a year, it's going to be really, really tough at 10, 15, 20, 30 million in ARR to grow into a $500, $600, $700 million valuation. I was having coffee this morning with somebody that's a part of the executive team of a business that's done 30 million 4 years in a row. So they've just been basically flat. And it is a business that is easily commoditized by AI. And so for me, when I think about that, I worry about I guess I worry about not just those fund vintages, but I worry about the size of the venture capital industry relative to the potential valuation for some of these companies that used to require a lot of capital, a lot of engineers. They're probably going to require fewer engineers, or a low-cost competitor can commoditize some of the features that they've been going to market with. So there's this conversation out there that vertical SaaS, or SaaS in general, will be meaningfully hurt, even though the software environment may return. And I feel like if that's true, it might also be true that lower cost competitors, or people, one engineer building something with GitHub, with Copilot or something like that, can build commodity tools that don't require per seat licenses for SaaS tools. And the consequence of that is maybe that's not a billion-dollar business, but it impacts the business model of venture capital meaningfully. But that might be offset by the growth of AI and just a shift in terms of emphasis. Are you worried about the size of the venture capital industry relative to the potential valuation of venture, of sort of like the dearth of venture scale investments because of deflationary effects of AI?
Yeah, that's quite a question. I think the venture capital, the asset class grew enormously. Of that 300 billion when we hit the high water mark, 81% of that was raised by non-traditional venture capitalists. Hedge funds, crossovers, corporate venture capital. And the vast majority of that is late stage capital. That late stage capital exists because 20 years ago, when Microsoft went public, they had 25 million in trailing revenue with 6 quarters of profitability, and they went public. You can't do that at 25, you have to do it at like 150 in trailing. So there's 6 to 7 more years of execution that then like the late stage market is now supplying instead of the public markets. And so there's like the word like venture capital, or what a venture capital firm has really changed. I mean, even the definition of the Series A has changed. And so if the vast majority of those dollars are going in late, then I think you can make an argument that like the multiples that people are willing to pay, the valuations people are justifying in the mid stages, it's really hard. For a lot of these categories that maybe were a bit smaller than people thought, or were underwritten to be significantly larger with much higher multiples. But I think at the early stage, I don't think there's, and that's where we play, so I'm kind of talking my own book here, but at the early stage, there's just so much you look at San Francisco's share of unicorns has gone down, but the total number of unicorns has exploded, for example. There'll be a correction there, but there's just so much more innovation broadly at the early stage that I do think at the seeded A, there's not an oversaturation of capital. The market has become more competitive, no doubt, but it will become less competitive in the next 3 or 4 years because it will be harder and harder for emerging and new funds.
Well, I guess that's an interesting point. I was going to ask something about that correction as well for early stage, which is the overinvestment. I mean, you talk about those growth equity funds, they came down. I mean, we saw them do Series A. Insight did our Series A, a fund that you wouldn't necessarily expect that.
This episode is brought to you by Clary, the only unified system purpose-built to help you run revenue. Spending your Sunday nights manually inspecting deals and jotting down actions for your sellers? That's the old way. Clary's platform surfaces the insights sellers need and allows them to take action, all in the flow of work, so nothing ever falls through the cracks again. See how Clary can help you run revenue like a pro at clary.com.
And so the follow-up question then is like the companies that you're funding at the seed into the Series A, they're competing with a high volume number of companies that have a ton of venture capital dollars deployed. So all of the optimism, the three of us are also optimistic about 2024 in the same way you are, but know that there's still a correction that needs to work itself out. And I'm curious to see how you see that playing out in the venture for the companies that are in the seed Series A that are going out to market to raise at the end of this year or whenever that might be.
Yeah, it's really tough. I mean, so if you're like a top decile, top quartile company, I think your valuation really has meaningfully changed from 2020 to 2021.
Right.
You can look at the AI companies and they haven't changed. And then if you're not one of those companies, then nobody really knows what a Series A looks like. Is it $1 million in ARR? What is sales efficiency? I did a survey. Most people are kind of operating at like a bird multiple of 3x or driving to a bird multiple of 3x. But I think at least for the most of 2023, a lot of venture capitalists a lot of VCs just sat out the game. And And so the bid-ask spread was too big. The market wasn't functional. There's no data there. So 2024, we'll see where it kind of all ends up. We all, venture capitalists raise funds. We need to deploy. Younger people want to be promoted. In order to be promoted, they have to invest in those companies. Not so much of a pressure on the general partners, more senior people on a firm, but that's definitely sort of a pretty important motive force here. And we definitely saw a pickup in like mid Q4. I'd say Q3 was really quiet. Mid Q4, there were so many companies coming to raise capital, and then it sort of quieted. And now I think it'll pick back up again. But I think it'll be like an okay year. It'll be an okay year after coming off a.
So if you're a founder for a seed going into Series A company, what would you say the metric, you mentioned a bunch of metrics, and that $1 million theoretical number is there that a lot of founders, and I mean, I don't truly believe in that number, but like, what is the KPI that I know it's going to be industry dependent and a lot of things dependent, but is there ones that that are being talked about more than others?
So the one that we care the most about is the strength of the pipeline. You can be at 100K in ARR, 500K, $1 million in ARR. If you have like 5 to 6x pipeline and quota coverage.
Well, that's interesting.
That's interesting.
Yeah, because
that's not on any deck, right? Like I haven't seen a deck so far for a Series A where in the top 3 slides it's like, look at our pipeline. Like that's a cool slide.
Yeah. So why do we care about that number? Well, if you have 5 to 6x pipeline to quota ratio, I know you'll hit Q1 and Q2 after we invest.
Yeah. If I'm a founder and I have that strength of pipeline, I would put the contact's name and the decision maker. Hey, like this is going through a procurement. Like I'm going out to raise. I feel conviction around these deals. Yeah. And here's the contacts you could connect with.
Well, so why is this important? Well, in the last year,
I don't know if that's a good idea. And then the whole thing, the whole thing evaporates. They call all of their fun. I joined a company in 2018 on the strength of the pipeline, and they didn't have like a methodology in place. And then as soon as I started doing pipeline inspection, I remember it was like I kept asking the founder. He's like, JP Morgan, $4 million. I'm like, you sure? $4 million. He's like, absolutely, 100% $4 million. We go into the first meeting with JP Morgan. I'm like, that is a zero. That's not, I don't even know what that is. That's just a conversation.
Damn, that sounds like a you problem. That was a qualification challenge on your part.
Anyway, that's an aside. What are you going to say, Asi?
We had Jason Lemkin on recently, and we were talking about the exit markets. And obviously, with a very thesis-driven approach, you're going to be very thoughtful about valuations. You're going to take the exit market into account. We've been stuck at pretty low valuations for a while. Jason was saying he's quite concerned about this, the public market comparables right now. And he made an interesting point, which was that he's like, it's not written in stone that when interest rates go down, that these valuations go back to 20, 30. And so he's concerned that if they stay relatively where they are, does this assembly line break? We know that the long-term average was give and take around here, but so much has evolved since then, including I was reading the Mindbody Bessemer memo over the weekend. That was like 10 million in revenue and 42 million pre.
This is how Asid spends his time with 15-year-old.
This is how much of a life I have, guys. People have hobbies. I do this. So a lot has changed in 10 years, right? And so it's steadying itself at this number would be concerning. What are your thoughts about what happens in the public markets with valuations over the course of this year, as well as just your general thoughts on M&A?
Yeah. So I think okay, so when interest rates are cut, it's convex, right? So let me do it this way. So if you cut from 5 to 4, it has a little bit of an impact. But if you cut from 2 to 1, that's a 50% reduction in rates. So the closer you are to zero, the greater a single point or 100 basis point cut in interest rates has on valuation because of that convexity. So in a sense, he's right? Like if we cut from 5.5 to 4.5, that doesn't have nearly the impact of cutting from 2.5 to 1.5 on forward loan. It shouldn't. But because if you're doing a DCF or whatever, you're discounting the future in your R, the convexity doesn't play your favor. So I think we've got some companies now trading at 16 to 17 times forward, which on historical basis are really high. I just feel like the top 3 companies kind of in that range, and Datadog and stuff like CrowdStrike, I think. And those I think are pretty healthy multiples, right? And so if we could sustain these kinds of multiples, then it's okay. I think we're in a good place. The hard part is going to your point, Sam. If you have a company that's doing 30 a year or growing 10%, the valuation multiple on that company is probably like 1 to 2, maybe 3 times revenues, or it's valued as a function of cash, right? All of a sudden, the valuation methodology shifts from ARR to cash. And so then it's, well, how much cash can this company produce as quickly as possible? They're trading at 20 to 30 times. So what does that mean for acquisitions? Well, I think PE continues to be super active. I wrote this 11% of the publicly traded companies, software companies that I track were taken private in 2023 by PE.
Wow.
So you had 70 companies, 8 of them were taken out. And that doesn't include like Cisco buying Splunk. And that's because like if you look at the operating metrics of some of these companies and you benchmark them relative to their peers, you can see that like some businesses grew up in an environment of excess or of capital cost being close to zero. And so if you can revert them to the mean, then all of a sudden you actually have a pretty beautiful software company that's spitting out. And so, I was looking at this with a journalist yesterday where we were going through the bottom 10 companies in terms of growth who had a free cash flow margin of minus 10% to a positive free cash flow margin. And then there are 5 to 10 companies that I think, fit that margin, fit that profile. It could easily be taken out by PE because as the cost of debt decreases with interest rates being dropped, you have a nice opportunity as valuations, right? So as we sort of plumb this bottom here, or what I think is the bottom of valuations, it's a really good time to deploy. Plus the PE funds, just like venture capitalists raise huge funds. The PE firms raised huge funds recently. And so there's a lot of money to deploy. So I think on the PE side, it will continue to remain really active. Strategics, the big question here is the FTC. I mean, you think about like the top 5 acquirers of technology. Yeah. Apple has an antitrust suit brewing against it. Adobe, Amazon, Google has antitrust, right?
Yeah.
Facebook has antitrust that would do that with customer. And so if you take those 5 companies, that's 75% of market cap and 70% of M&A dollars.
Yeah. Salesforce has never had, I don't know, maybe I'm wrong about this. It's interesting that it hasn't like crept down to like the Salesforce level.
Interesting.
With these.
I think you have to be $1 trillion or above in market cap. It's kind of my mental model for it. But, maybe there's a change in administration and Lina Khan goes away, or she chooses something else. And so then all of a sudden M&A is open. You still have like the EU and those other blocking jurisdictions. But I think like that really, really big M&A.
Right. We were saying that like the big M&A is probably not, the Figma Adobe thing has a big chilling effect on that. But there's, my thought was there's still meaningful opportunities around 2 to 3, 400 million. But that, which I guess when you're thinking about total venture returns, it's like the massive M&A that really like redounds to all of the shareholder letters that GPs are going to write. But for founders and entrepreneurs, as long as they kept their valuation under control, a 200 or 300 million exit might be just good, might be great.
Yeah, but you could even I think you can get to a couple billion, right? Salesforce, ServiceNow, those kind, 50, Datadog, 50 billion and up can acquire a company for 1 to 2 billion very, very easily. Yeah. And so even though low billions, I think you'll be able to see, and the number of companies there is not small.
Would you expect the companies that were taken private that, I don't know if you said 11 or 11% of the companies you're tracking to be restructured and go back to the public market? Or do you think they're going to remain private for now?
2 to 3 years, they'll be floated again.
Yeah. And there are also these really interesting like combinations that are happening. Like we're working with one that was bought by, actually, I don't know if I can say the names, but they bought 2. I learned this lesson.
You have learned.
You caught yourself. Austin normally doesn't catch himself.
Tomas, he was saying on a recent episode, he's like, so-and-so is going to have a big layoff, but it hasn't been announced yet. I was like, well, maybe we have to beep that out.
We have to beep Austin out, but also we were told by listeners that we swear too much, so we have to beep ourselves out.
I don't think we've sworn that much today.
This time we've been on our best behavior. We've learned lessons really quickly. That's why we are good. We learn quick. But yeah, they're combining these 2 organizations. The product's getting more powerful. They've got efficiencies within it that they can create, and then they want to take it public. That's super interesting. Want to click into AI, but first we have to pay some bills. This isn't all in. We don't have planes and billions of dollars. We need to pay some bills first. Okay, so you were on the 20VC Harry Stebbings podcast a couple of months ago, 8 months ago, right? Timeline correct?
I think that's
you remember the day, right?
Yeah, it
day, hour,
Monday. And you guys had discussed essentially who was winning the AI race at the time and who was losing. And you mentioned Google was the one that was losing in the moment, which is obviously really interesting, right? They created this disruptive technology within the organization, but then innovators' dilemma played out over there, and that created this opening for companies like Microsoft to take some market share and create some anxiety within Google. Now, since then, a lot has happened, right? OpenAI is on a $1.4 billion run rate. They've had a CEO gone, CEO back, but that's different. Anthropic is at $1 billion. You've got a bunch of startups that have come up at the application layer, infrastructure layer, super interesting. Some are getting to a decent size scale in terms of revenue. So a lot has changed over the last 8, 9, 10 months. Can you give us your updated take on who's leading this AI race, who's lagging it, and what you've been surprised by during this period?
Yeah, I mean, I think Microsoft is definitely leading it. If you think about their ability to cross, I think they've got 2 products now that are close to or bigger than $1 billion in ARR in AI. And you think about like Office upselling a $29 a month seat across 330 million paying subs, basically the population of the US. You get to pretty big ARR pretty fast. And then tying into this consolidation dynamic, right, where everybody in 2023 was looking to buy suites and consolidate on a best of budget instead of best of breed, Microsoft really picks up there. The other dynamic that plays to Microsoft's favor is they have the OpenAI technologies. Their Facebook is paying them to train the Llama models, and then they're offering the Llama models, and then they're taking the open source plus producing their own. So they really are like the Turkish bazaar of LLMs, and they have the distribution within the enterprise where people are willing to pay a pretty significant premium. So I think in the B2B world, Microsoft is the winner there. Google is very far behind. Amazon is really far behind. You have others in there, like Anthropic has done a really nice job of embedding themselves in mid-market SaaS companies. Definitely seen that happen. And then I think the big question now is, okay, on the consumer side. Well, one of the predictions that I wrote, I'd be curious what you guys think is, I think half of searches by the end of 2024 are answered by a generative algorithm. Ooh. And I think a big part of that is mobile. And the dynamic there is Samsung wants to differentiate their phones from Apple, differentiate from Huawei. Well, everybody is running Google search. What if you had a generative experience instead? Would people shift and buy an LLM in the old phone? And is that enough to sign a big strategic deal? It might be. And then, Google, you're starting to see it actually on google.com, and Bing is starting to do it. So I think there's a big shift in the consumer landscape, which could be really destabilizing to Google if they don't catch it. They've done the Gemini stuff and they're getting close to parity, but I think it's
that's a really interesting prediction. Sam, what do you think about that prediction?
I don't know. What I think is that, well, first of all, I don't know about, again, this is sort of like to Tomas's point about like the cost of, minting a token or transaction fee on a blockchain, shrinking by a factor of 1,000. I think the latency on, getting information back from LLMs is still making it pretty difficult to do mobile style work and queries on them. But I'm sure that that's going to shrink too. I think, I guess generally, I think we can call it search. I definitely think that there's some personal assistant style AI / LLM use case that the world needs to be trained on. I was on my WhatsApp group with some of my buddies. One of them's head of IR at a public company. One of them runs $1 billion under management as a portfolio manager. Both of them are writing their investor letters, and they were saying, I'm struggling to figure out how to phrase this. I said, why don't you just paste it into ChatGPT and get 5 different responses? And they're like, oh yeah, I'll do that. Yeah. So my point is that I think there's a lot of people that their instinct is not to use an LLM to answer basic tasks. And I think once the world in whatever form factor trains them on how to do that, I think that's when you'll see a true inflection point in terms of usage. So I guess I would probably agree with Tomas, but I don't have a strong opinion on when that's going to happen.
Yeah, that's interesting. AJ, what do you think?
Well, I was walking by. My wife was talking to her accountant on a Zoom, and I overheard the accountant talk about AI summary. First time, she's like, "It's amazing! It's this thing you can be talking for 45 minutes, and then it just somehow knows." So the general public aspect of it's kind of funny, but to be fair, like this is still relatively, even though we're at the tip of the spear in the tech, like I mean, all four of us probably use generative AI 6 to 7 times a day. And sometimes it's just second nature. I know we've talked about this, Asa, previously when we've done searches for like, I think you even mentioned sales talent agency, like coming up in a generative AI search.
Yeah, we've received inbound leads from it.
Yeah, and we just had our first inbound lead from for QuotaPath from it. So
well done. That's awesome.
Yeah, and we like one of my chief of staff Graham is like working on training the LLM just to make sure like it's like I don't even know what it's called. Is it an SEO LLM play? Like what is this called?
It's an SEO play, basically.
It's an SEO play, but there's not a name for it yet, is there? There probably is. There'll be a category. There'll be 10 companies that are going to get venture funded tomorrow on this play, but it's just fascinating to see how it's changed. I think even in our conversations week to week, we've cooled off on talking about it a little bit. And I think that latency is a piece of it. And I just think in general, we've gotten used to, I feel like I can pick up on generative AI really quickly. If someone has like, we aim to, and I'm like, oh, that's just a generative AI. The word aim comes up in like every
all those LinkedIn posts
response.
They're LinkedIn posts that look like the hook is like a Wall Street Journal like headline, and so you can see it. We've spoken about it a bit less recently, but my usage of it has definitely gone up, and so I've not been using Google much at all. Like I would say probably 10% of the time I've gone on Google. Like on my browser, I don't have a million tabs open. I like to keep things very clean. And so it's my email, my calendar, and ChatGPT. Like those are the 3 that are always open, and then the random shit that opens up. And so I'm using it a lot. But I think the challenge is that we're still at the early adopter phase on B2B and B2C when it comes to this technology, right? There's a lot of interest, there's a lot of curiosity. You can kind of visualize where things are going as well. But then when you ask people, like you hear a lot of what, Sam was saying, which is like people haven't thought about how to actually integrate it into their lives on a day-to-day basis. So to imagine that 50% of the population would be using it like that, I think we get to 50% penetration of society faster than any other technology, but maybe it takes a little bit longer than 2024. So,
Hassan, how do you have 3 tabs open? I have 63 open on my
computer. That's madness. I would cry. If I looked at my browser and it had 63 tabs open, I'd quit. I'm done.
I am an agent of chaos over here.
It's madness. Like, what about, so one of the things that people have been talking about when it comes to AI is this, as Sam Altman calls it, an amplification tool, right? It makes people more productive. So it lifts the floor and the ceiling of an organization by making it so that each person can achieve so much more, so much faster. When you look at the S&P 500, there's some really interesting data on how many employees per $1 million of revenue. So in 1986, it was 6.4 employees. By 2000, we got to 1986 it was 7.8, 2000 was 6.4, and then we've been at about 5.1 since 2008. And major inflection points are these platform shifts in technology, right? Like you've got mobile, you've got cloud, you can see how it affects it. Obviously AI is the next one that's going to bring this down, and I think the question that's top of mind for so many people right now is that when will it bring it down? How exactly? Like, what's the practical implementation of it that we're going to see in 2024? Because we've yet to see these really across the board practical implementations. And so curious where you see them play out other than on the developer side, right? Because we know Microsoft Copilot is working really well, but where else? Like, especially if you can click into go to market a little bit, where do you think teams actually will be using this and how?
Yeah, I mean, I think the main area is really on the sales and marketing side. Think about like the automation of an SDR, which full automation of SDR, I don't believe in. But I mean, I'll give you an example. So, before we're thesis driven, so we'll research a company and a space for a long time. And I really wanted to understand a business that I knew nothing about. And typically what I do is I pull up all the YouTube videos, all the Spotify podcasts of a particular founder. I'd go through all the social media posts and the blog posts. And that might take me like, I don't know, 2-3 days to go through all that and summarize it. And this is all just background work to be able to write an email to the founder, right? Just to get to a place where we're credible and we know what you're doing.
This is your opening email to someone to say we should chat. Wow.
So we think really highly of a business. We want to make a strong, positive impression. We want to understand the business.
What was your hit rate on those?
It's very high, extremely high. And so that used to take me 2 or 3 days. So now what do I do? So I was there. An academic is starting a company, right? He's coming out of a great school, has written a bunch of papers. And I took all the podcasts, all the YouTube videos, put it into a summarization engine and said, summarize this in 1,000 words. And then I took that and I said, send an email to this person. And then I took the academic paper, uploaded it to Claude, which is Anthropic's product, and said, summarize this. And I read the summary and I had the email. And then I sort of made this connection between what this person was doing and something in Web3. And so then I asked Claude, how strong, like, is this real? Am I imagining that there's a real connection? And Claude comes back and says, it's kind of tenuous, right? And so that I kind of put like that kind of tenuous point on like, I'm not quite sure, but what do you think? And the person responded. And I did that in 30 minutes instead of 3 days. And so I think like that's where you see the time compression is like when we talk, it's highly uncompressed, right? When I speak words, there's not a lot of information per word that I'm giving.
Especially when AJ talks.
Sam has been waiting for his joke. Every week for the last like 12 weeks, I've had great one-liners at Sam, and he has been waiting on that.
Sorry to interrupt. Keep going. We're listening.
And so I think what they're really able to do is take a lot of human output and compress it.
So the follow-up question is human limitation, right? Like the dispersion of technology across society is like partly the capability of the technology and partly us, like, do we lean into it? Do we use it? Are we going to make a bet? Or do we want everyone else to start using it before we start leaning into it? What are your thoughts in terms of that? Like, do you think that the average Series A, Series B, Series C company is going to be getting the full benefits of AI that are available in 2024? Like, do you think it disperses like that?
Okay, so I met the model I asked a bunch of VPs of sales. So we kind of kicked off this conversation because I wrote that blog post about, I quoted it decreased 20%.
Yep.
And so I talked to a bunch of VPs of sales and I said, okay, now all of a sudden, 80% of the emails, 80% of the content of the individual emails can be automated. The responses can be automated. Oh, I mean, you have this time compression that we just talked about. You don't need to research an account for whatever, 25. Now it's 25% of the time to research an account that it used to be. So an AE should be able to produce more leads, right? Should be able to handle more because there's just more time spent. There's automation on the CRM that's coming and all those kinds of things. And so the consensus I heard, and I said, the question to them was, when do you increase quota as a result of AI? You should, right? Like, I think it's hard to argue the opposite. It's hard to argue the opposite because there should be a productivity gain, right? You look at the research reports coming out of OpenAI, or you've had white-collar jobs, like half of their tasks can be semi or fully automated. And I think that's true for an SDR. And so what I heard was the most aggressive, putting aside like sales kickoff and you don't change a sales quota except for every once in a year. The most aggressive VPs of sales, if they had their druthers, would likely raise quota in Q2 or Q3 24. Most people, though, will wait until a full year of 24 to see the productivity. And then if they see a significant increase in productivity, raise quotas in 25 or 26.
I can validate this, actually. This is actually very interesting data here. You're bringing up a very fascinating point, which is, for us, we deal with RevOps and finance in terms of thinking about planning and quotas and when to adjust. We are seeing, and we've seen a massive shift over the last 2 years into where commissions lands. It was, RevOps and CROs were very tied to comp. That has shifted heavily into finance. This year it is shifting back to sales leadership, who is pushing harder for their teams. They're understanding how productivity and how quota is going up. They want to see it, but they want to adjust, kind of punt on it and adjust it in Q2 and Q3. This will be one of the first years where I think a lot of quotas will be adjusted. Last year we went through it, but that was kind of like had to go through a recut of plans. This year we're going to see it, I think, because of what Tomasz is actually talking about, but I'm actually hearing that in the market. So that's
fascinating. So I think one of the things you're going to see one or two AEs within large organizations crush their.
Yeah, that's
you've never seen before.
Yeah, and they're like, how the hell is this person
like
doing
20
this?
million on a $1 million target?
Gary Service at our summit.
Third crush.
It's that thing of like, AI is not going to replace your job. Somebody that knows how to use AI better than you is going to replace your job.
Yeah. So there's this professor at Duke who teaches a writing class, and he mandates the use of ChatGPT in class.
Oh, wow.
And the caveat is, if there's one error in a paper you submit, you fail.
Wow.
If there's a misplaced period, if there's a misplaced comma, if there's a word that's not, you fail.
That's so
But the whole point is, like, the workers who are coming out who know how to use this technology.
Yeah.
It's like the slide rule on the calculator.
Yeah.
You're right.
What a dangerous thing to have for the people that learn how to use it. Well, this has been great. Thank you so much for doing this.
Thank you, guys.
As we come
Thanks
into
for coming, Tomas.
the end of
This
the
is
hour.
so fun.
Shoutouts, right? Our wins of the week. That's how we end this. And so each one just says something quick about a win that you've had, or somebody or something that you want to shout out. We're going to start with you, since you're the guest.
Oh, we've got a verbal on our 6th investment.
Let's
There
go.
we go.
Really exciting. It's closed in about 6 weeks and feels good.
Series A, Series B?
Series B. So we closed one Series A. We got the verbal on a Series A last week and a Series B this week. So it's been a good start for the year.
Good start
Have
for the
any
year.
of your investments done follow-on funding yet?
Not yet.
Not yet. Yeah.
But soon.
Clearly.
AJ.
Congrats. I'm going to give my shout out to Liz Christo, Kane. Liz is on my board, stage 2. She sent me this lovely pack of strawberry Jolly Ranchers with a note. First off, I didn't know who they were from, because the note didn't say who they were from said, I heard this was your favorite Jolly Rancher. Congrats on the year. And it's been great working with you. And that was it. It didn't say her name or anything. And I was like, this is weird. No one's ever sent me something like this. This is awesome. This is amazing. And then like 3 weeks later, Liz was like, hey, did you get those strawberry Jolly Ranchers? I was like, how did you even know? And she's like, I remembered a year and a half ago, you mentioned that that's your favorite candy. So shout out to Liz for making it. By the way, Jolly Ranchers, if you eat 3 of them, 70 calories, 11 grams of sugar. I've had this for 3 weeks, so I have to be very careful with these. Just so you know, I found that out today. So those are going to get moved out of my office, for the record.
That's a great gift. I'll go, and then Sam, you end it for us. And so mine is Fred Mather. Fred is Water Pavilion. He's one of the OGs.
He's OG Pavilion.
Helps Sam get the ball rolling, and he runs On the Bench, which is the program for executives that have been impacted by the layoffs and the state of the market and are looking for a job and trying to figure out how do you navigate this environment to find a great job. And I've shouted him out last time I'd gone in, and I went back in yesterday to share the state of the market with the group. There were about 50 execs over there, and every time I go there, I come back energized. This was one other time. The collaboration, the community they have within each other, that's like a micro community within the larger community. They're so supportive of each other, and it's just such great work. And so just shout out to Fred for being really cool and doing great things. Sam.
I will go next, and I will wrap us up. I want to give a shout out. 2 shout outs. Well, 3 actually. First, Aaron Leader. Aaron runs sponsorship sales for us. Maybe he's using ChatGPT, Tomas. He's closed $300,000 in sponsorship sales in the last 6 weeks.
Let's go.
And $100,000 in the first week of January, which is pretty good. And we're starting to include like a 3% early payment discount if you pay within 48 hours of signature. Meaning if you pay quickly, and so we signed like a big $50,000 deal and immediately got 50,000 times 0.97. So that was great. And then I want to give a shout out to Albert Chun. Albert was a brief fractional head of CS for us, and he works at Invisible. Invisible is this company that provides a lot of the contract AI trainers to Meta, to Alphabet, to AWS. That is a company that is absolutely on fire. They tripled and are just, well, I won't say how big they are, but they are scaling very, very rapidly. It's a really cool company. And then, of course, I have to give the final shout out to the Michigan Wolverines for beating the Washington Huskies, winning the national championship. And I was just struck by, one of the first things everybody said when they were interviewed after they won is how much they're going to miss the team and how poignant it was, because they had this 15-0 season. And it just, when you're out there, it's what Tomasz said about, living in the edge, living in this moment of acute, aliveness, when you feel so alive because you're living in a period of consequence. And I think we're all doing that right now. And even though sometimes it's super stressful, I think we're all going to miss the days when we were of significance in the arena, making decisions, driving people forward, and changing the outcomes of people's lives through our businesses. So kudos to us, and especially to Jim Harbaugh and the Michigan Wolverines. And with that, Tomasz, thanks again. Great seeing you.
Thanks,
Give us
Tomasz.
5 stars on the iTunes store. Rate us wherever you get your podcasts, and we'll talk to you all next week. Thanks, everybody.
Bye, everyone.
Thank you. Bye, everyone.
This episode was brought to you by Affinity for Salesforce. Automate the creation, update, and enrichment of Salesforce records and use your network and relationship insights to find, manage, and close more deals. Check out Affinity at go.affinity.co/pavilion.
Thank you for listening to this episode of Top Line. To learn more about the trends, news, and developments impacting the world of B2B SaaS, head to joinpavilion.com, where more than 10,000 of the world's top go-to market leaders go to achieve and unlock their full professional potential.